How is everyone doing? Welcome to this Saturday night, August 23rd, 2025 edition of the Strategy Room. We have got a jam-packed show here tonight. I've got a lot of stuff to go through with everyone, and the hits just keep on coming, as they say. So, we're going to have Rasputin live later on in the show. No, if anyway, well, if you watched last week, you get that joke. But anyway, all right. So before we get rolling in the article, we got a lot of stuff to talk about. We got to Jackson Hole. What were Jeremy Powell's comments yesterday? What are some of the big takeaways? How are Fed governors thinking about interest rate cuts potentially in September? We're going to look at some economic indicators. We're going to talk about the one Fed governor who's on the hot seat right now for potential mortgage fraud and what that could mean for her future. We're going to talk about the potential new Fed chair that could get hired in September as interviews are going to get kicked off for that. We're going to talk about all the latest and greatest in tariff news. I got banking news for you. We got economic indicators and a whole bunch of other just related stories and things going on. So I've got a ton of stuff for everybody tonight. So as usual, we will kick it off here with, I always love to go to the debt clock here to start us off. So we're still cruising at a little over $37 trillion in national debt. We still have our $2 trillion annual federal budget deficit. The Doge clock has gone over $600 billion, $606 billion to be exact, with savings per taxpayer now of $5,395. So I hope that's a real number. Again, we've talked about that a lot in the last few months. Not quite sure how real that number is, but if it is a real number, that's just fantastic. And then, of course, our debt to GDP ratio still sitting at 123%, not anywhere near where we want to be. So that's, continues to not be that great. So, but anyway, all right, well, let's get into, before we get into Jackson Hole, I just want to run through a couple of quick stories here real quick, because this was just kind of the big news here of the last day or so. The U.S. government takes a 10% stake in Intel as Trump expands control over the private sector. Well, kind of. Commerce Secretary Howard Lutnick said that the U.S. government has taken a 10% stake in Intel. President Donald Trump and the Intel CEO Lip Bhutan are set to meet. Earlier this week, Intel announced that SoftBank would make a $2 billion investment in the chip maker. So basically, the U.S. government is going to look to take a 10% stake in Intel. I think that Intel actually needs this, believe it or not, just because of a lot of the issues that Intel has had going on recently. Now, critics, there's a lot of people that would say that, this is not the kind of capitalism that, we want to be showing, that the government shouldn't be, taking stakes in these companies. And again, I think that gets back to, how often are you doing this? How much of a stake are you taking? Why are you taking that stake? I mean, I think there's a lot of questions in there. If you're talking about Intel, a company that one of the big things that they do is make microchips, they're a big player in the semiconductor industry. And if the making of microchips is considered part of national security, then I think there's a big justification. I think the government has a vested interest in basically keeping Intel afloat, keeping them manufacturing microchips, but more importantly, manufacturing those microchips here in the United States. So again, for the most part, I think this is actually a good thing. We will see how it plays out. Now, I think the big question becomes, one of the other parts of this is the CHIPS Act. We've basically seen where a lot of people said, the government may decide to start taking ownership pieces in other companies that took money as part of the CHIPS Act. Well, that might be another, kettle of fish, as they say. We're going to have to see how some of this plays out. For one, do I want the government, taking stakes in a lot of these companies? No, I do not want this. I do not want that per se. You certainly don't want that to be the norm, or you don't want that to be, what's going on. Just in this particular case, though, I think with Intel, I think this would be a good thing. So, but like I said, we'll keep an eye on it, see what's going on there. Cracker Barrel faces social media pushback on new logo and the brand refresh. So shares of Cracker Barrel Old Country Store dropped roughly 7% on Thursday. They did rebound a little bit on Friday, but they basically plummeted on Thursday after the restaurant unveiled its new logo as part of a larger brand refresh. Cracker Barrel has said the refresh will still maintain the brand's rich history of country hospitality. However, many social media users have criticized the new simplified logo, especially those in conservative circles. Yeah, I think this was just another just absolutely self-inflicted bonehead move on the part of Cracker Barrel. I mean, obviously their CEO and some of their other employees coming out talking about this, just they're just digging the hole just even bigger, even just digging it deeper. So I think this is just a horrible, horrible move on the part of Cracker Barrel. I think they are going to greatly, greatly regret doing this. I think we all know why they did this. I think, when you, go woke, go broke. So, as the saying goes. Again, I think this is just a horrible self-inflicted wound on their part. And, hopefully they do something there to try to right that ship there. Not good. And then along the same vein, Target shares tumble as retailer picks a new CEO, says sales fell again. So Target posted fiscal second quarter earnings and revenue that topped Wall Street expectations, but the company stuck by its full year outlook, which forecasts a single percentage point decline in sales, and they named Michael Fidelek as its new CEO effective February 1st. Now, people were hoping the CEO was going to pick an outsider to come in and basically kind of shake things up a little bit, get things going. But they decided to pick this gentleman, Michael Fidelek, that, he's a longtime Target employee, been with the company for a long time, held a number of different roles at the business from what I understand. And I guess they went with him because maybe it felt more safe or more comfortable, whatever. But the shares, company shares of Target are just, not doing go so well. And Target has just made one stumble after the next, and it's just been kind of a bad show over there at Target as of late. So, but again, Target, Cracker Barrel, you could go back and look at a lot of the same kind of stupid things going on at these companies. You can see kind of a pattern here. So those are some of the big stories here of the week that were getting a lot of attention. But with that being said, let's go into our big story of the week, which was basically the Jackson Hole Symposium, where Fed Chairman Jeremy Powell was giving his final speech. And, Jackson Hole is a very big event. If you guys hang on till the end, for people to watch all the time, at the end of the show, I do my story of the week. And my story of the week this week is going to be on Jackson Hole. So I'll give you guys a little bit more details on that toward the end of the show tonight. But let's look at this article here for a second. 5 takeaways from Fed Chair Powell's final Jackson Hole speech. So current conditions may warrant an interest rate cut, said Fed Chair Jeremy Powell. So Federal Reserve Chair Jeremy Powell presented his final keynote address at the central bank's annual Jackson Hole Summit on August 22nd, yesterday. Powell's highly anticipated speech signaled that monetary policymakers could be set to lower interest rates for the first time since December. But his prepared remarks also cautioned about potential inflation and labor market risks. So what are the 5? So here are the 5 key takeaways. So interest rate cuts coming, possibly, maybe, I don't know. Powell left the door open to an interest rate cut. So since the benchmark federal funds rate is 1% lower than where it was a year ago, and the unemployment rate remains around a historically low level of 4.2%, the current environment will allow the Federal Reserve to proceed carefully as we consider changes to our policy stance, according to Powell. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance, Powell said. While he did not explicitly state that the Fed is restarting its easing campaign at the September Federal Open Markets Committee, policy meeting. This is the closest he has come to indicating a rate cut. Powell's prepared remarks may have also been surprising, as his colleagues had expressed a lukewarm reception to a potential interest rate cut, citing concerns about inflation and the need to wait for more data between now and next month's meeting. I'll have more on that in the subsequent articles following right after this one. So, curious kind of balance. So, data indicates that the labor market conditions are in balance. However, according to Powell, there are a curious kind of balance stemming from a slowdown in the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising, he said. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. The Fed had presented various employment figures, including the July jobs report that showed monthly payroll growth slowing to a 3-month average of 35,000. But he noted it presents only a partial view of the overall labor market. It does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market to an outcome we want to avoid. And then we talked about inflation risks tilted to the upside. So a primary reason the Federal Reserve has maintained the benchmark federal funds rate within a target range of 4.25 to 4.5% is the impact of tariffs on inflation. While higher import duties have not dramatically bolstered aggregate inflation levels, Powell says they have begun to push up prices in some categories of goods. The effect of tariffs on consumer prices are now clearly visible, Powell stated. We expect those effects to accumulate over the coming months with high uncertainty about timing and amounts. Comparable to what officials stated in the July meeting minutes, tariff-driven price increases may take time to propagate through the U.S. economy. He noted that upward pressure on prices from tariffs will need to traverse through supply chains and distribution networks, adding that continued evolution of tariffs rates would lead to potentially prolonged and adjusted process. Still, according to Powell, tariff-driven inflation might be transitory. Gotta love it. He couldn't resist himself. You had to get transitory in there one more time, baby. Once more with feeling. All right, and then we go on to the monetary policy framework changes. So Powell provided updates on the Federal Reserve's review of its monetary policy framework, indicated change from the last assessment conducted by officials in 2020. 5 years ago, the Fed shifted to a flexible average inflation targeting strategy, which allowed policymakers to allow the annual inflation rate to run above the 2% target, following an extended period of keeping policy intact below that goal. However, inflation reached a 40-year high soon after, and the central bank shrugged off the increase as transitory, our favorite word there, not requiring policy tightening. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement. As I acknowledged publicly in 2021, Powell said, the past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs of necessity. Now, I want everyone to bear with me on a second here, because I want you to think about something. So what the Fed is saying here, what Jeremy Powell is saying here, is that, we had this program in place that we were going to allow inflation to hover above 2%. We were going to allow the inflation to hover over 2%, not really thinking that anything here was really that big of a deal. Then we were going to pump trillions of dollars into the economy. So we were going to allow inflation to hover over 2% while we pump trillions of dollars into the economy, not thinking, and we're going to put that money, wait for it, directly into the hands of consumers. And somehow in their mind, they didn't understand that inflation was going to run wild, and that somehow that this was going to be transitory. Are they morons? Because it sounds to me like they're morons. Like, it sounds to me like all those PhDs over there at the Fed have no idea what they're doing, because that's how stupid this sounds, and I can't even express how stupid this sounds. It's mind-numbingly stupid, which is just unreal. But anyway, I digress. Okay, so now what's the big thing here at the end? Wall Street cheers. So Powell's speech sparked a widespread rally on Wall Street. The blue chip Dow Jones Industrial Average climbed almost 1,000 points, or 2.1%, to a fresh all-time high. The tech-heavy NASDAQ Composite Index increased about 1.8%, while the broader S&P 500 jumped 1.6%. Forecast for a quarter-point rate cut in September spiked to 91%. From 75% on August 24th, according to an updated data from the CME FedWatch tool. The bar is extremely high now for the Fed to leave rates unchanged in less than a month. Chris Zaccarelli, CIO for Northlight Asset Management, said in a note emailed to the Epoch Times. So according to Zaccarelli, Powell gave himself an out should the economic data head in the wrong direction before the September 16th, 17th meeting. Additionally, he says Powell did not outline a path of multiple rate cuts moving forward. So, yes, he did it. However, the forecast now spiking to a 91% that we're going to have a rate cut here in September. All Powell had to do was whisper the words, okay, at the beginning of the speech. Yeah, it's probable that, we're probably going to have to start cutting rates soon here, okay? That's all he had to do for the market to just go nuts, okay? A lot of the other stuff on there was relevant. The comments about the policy changes are just, like I said, incredibly stupid. Wow. Okay. So those are the big things there. So we got this. So what were the 5 takeaways there? Potential, possible, maybe, somewhat, possible interest rate cuts coming. It's a curious kind of balance between, what they're seeing with the labor market right now. Inflation risks are tilted to the upside with tariffs, maybe. Then we got the monetary policy framework. Oh, Lord. And then Wall Street cheers. We had the big boom on Wall Street. So there's your 5 big takeaways from Jeremy Powell's speech at Jackson Hole. Now let's take a look at some other things. So Fed officials erase old policy that tolerated higher inflation. This is what we were just talking about. So the U.S. Central Bank retires a previous strategy that unveils a new approach that updates how inflation and employment are balanced. Oh, this should be juicy. The Federal Reserve said it would no longer intentionally allow inflation to run above the central bank's 2% target, even after stretches of low price increases, unveiling a revision to the bank's long-run strategy on Friday. As it turned out, the idea of an intentionally moderate inflation overshoot had proved irrelevant. No bleep, bleep, bleep. Really? You're laying this on us now here. We all knew this years ago, dude. You're just laying it on us now. Reflecting on how inflation surged far beyond the Fed's intentions as the economy reopened after the COVID-19 pandemic. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement. Of course, he skips over the fact about him dumping trillions of dollars into the economy. He just blows right over that. Oh, well, we were just going to let things hover a little bit, above that 2% range. And, and we didn't really think that was that big of a deal. But as it turns out, it was kind of a big problem. It was a big problem, moron, because you dumped trillions of dollars into the economy, directly into the hands of consumers. Yeah, that was going to cause inflation. That was going to cause a massive spike in inflation. And again, and this is important to understand. So when you go back to 08, 09, and people say, well, wait a minute, the Fed pumped trillions of dollars into the economy back in 08 and 09. So why did we not see this massive inflation back then? The reason being is because the money did not go into the hands of consumers back in 08 and 09. What the Fed did was a very crafty sleight of hand back in 08 and 09. What they did was they opened up these reserve accounts at the Fed, and they told the banks, take Wells Fargo, for example, and they said, listen, Wells, here's what we're going to do. We are going to deposit $500 billion into your account here at the Fed. Now the money has to stay here at the Fed, but it is your account. And you can now put that on your balance sheet, but we're going to pay you interest on that money because we don't actually want you to lend that money out. And so what happened there? That allowed all the banks to go on CNBC and say, "Oh, look at our balance sheet. Our balance sheet is all fixed. Look at that. We've got all this. Look at this, all this liquidity. We're flush with deposits. We've got money to lend. It is great. Hallelujah. We're saved. It's all wonderful." But then what happened? And over the next couple of years, people started getting aggravated because they were like, why aren't the banks actually lending any money? Oh, that's right, because the Fed didn't actually want them to lend any money. That's why they're paying them interest on those reserves. Now, fast forward 16 years later, that's a big problem. Why is that a big problem? Well, the Fed is losing. They have lost $235 billion in the last 2 years. And while they continue to lose all that money, do you know what they're still doing? That's right. They're still paying interest on those reserves in those bank accounts. Still paying interest on those reserves. So you can't make something. Meanwhile, in 2020 here, they dumped trillions of dollars, not into the coffers of banks, but they gave it directly to consumers to spend. And once all that money gets directly it's like a direct injection into your veins. Okay, once all that money goes in, guess what? The inflation comes, and the inflation runs wild. And they have to jack up rates to combat the inflation. And yet they're going to sit here and try to tell you guys that, oh, this was just a minor mishap. And, it turned out to be kind of irrelevant, I can't even fathom this, that they basically think they really do. Sometimes it's so obvious. They really do think people are stupid. They really do think this. And it's just, it's amazing. It is amazing. So, but let's carry on here. So, what did the Fed minutes tell us from last month? Well, they revealed broad support for holding rates steady. So almost all officials backed July's interest rate decision, even though 2 governors backed a rate cut, according to a meeting summary. So the Federal Reserve's decision to hold interest rates steady last month was broadly supported, despite 2 officials who dissented in favor of a cut, according to minutes of the policy meeting released on Wednesday. The minutes said almost all officials supported the decision, implying that part from the 2 dissenting officials, it was backed by the remaining 16 officials who participated. The decision followed a period of intense political pressure on Federal Reserve Jeremy Powell by the White House to lower interest rates. Officials maintained their benchmark policy rate in a range between 4.25 to 4.5 as they weighed importers, retailers, and consumers will split the cost of higher duties on imports. The written account of the meeting, released with a customary 3-week lag, suggested officials were divided over when they could be confident that higher import costs wouldn't lead to a period of broader rolling price hikes. Some officials said a greater deal could be learned in coming months, though officials said it would not be feasible or appropriate to wait for complete clarity on the tariffs' effects on inflation before adjusting the stance of monetary policy. So, a lot of flip-flopping here, a lot of back and forth. They don't know what's going on, can't figure it out. All that PhD, all that brain power, they just can't figure out what's going on over there at the Fed. Amazing. It's amazing. Let's look at some other things here. Divided Fed worried about tariffs, inflation, and the labor market. The minutes show. So a meeting summary depicted a divergence of opinion among central bankers who vote to hold their key rate steady came despite objections from 2 Fed governors who argued in favor of cutting. Participants generally pointed to risks to both sides of the committee's dual mandate, emphasizing upside risk to inflation and downside risk to employment. The minutes noted. Cleveland Fed's Hammock cast doubt on interest rate cuts amid inflation worries. So Cleveland Federal Reserve President Beth Hammock said Friday she would be hesitant about lowering interest rates as long as inflation remains a threat. In a CNBC interview, she said, "I don't want to move us to a place where we're being accommodative because I worry that if we're accommodative, we could reinvigorate the inflationary pressures." And then we had another Fed president. Kansas City Fed's Schmidt shows hesitation about widely expected September rate cut. Kansas City Federal Reserve President Jeffrey Schmidt, in a CNBC interview Thursday, expressed doubt about lowering interest rates in September, saying there's more work to do on inflation. Schmidt is a voter this year on the rate-setting FOMC. So now what did he say? So speaking to CNBC from the Fed's annual symposium in Jackson Hole, Wyoming, Schmidt pushed back on market pricing that points strongly to the FOMC lowering its key borrowing rate next month. We're in a really good spot, and I think we really have to have a very definitive data to be moving that policy rate right now, he said during a Squawk Box interview that aired Thursday. In September, we'll get around tables and we'll collaborate and we'll figure it out. But yeah, I think there's a lot to be said between now and September. So again, a lot of these guys, they're just, this is political. It just really is. A lot of this stuff is just political. You look at the numbers, like they don't have good reasons right now to not be cutting rates. You've got a major softening in the labor market. While the inflation is not yet at 2%, the inflation is certainly not anywhere near where it was a couple of years ago. There is a little bit of worry about it and about tariffs that we're going to see here in a minute, because I want to show you guys both sides of the story. I want to give you both sides of the equation here. But again, a lot of these Fed governors, a lot of them are just falling in line because of, maybe loyalty to Jeremy Powell, whatever the case may be. But again, they're just not, a lot of them are just not wanting to play ball at the minute, which is not good. So here we have a pertinent question. Is a second wave of inflation coming? That is an excellent question. And this is an article from Jeffrey Tucker. If anybody does not follow Jeffrey Tucker on X, I highly recommend you do so. He is an incredible economist, and he usually has some really good takes on a lot of things. So, and here's his take on this. So, the Trump administration has been urging a cut in interest rates. The reasons are obvious. This would make home loans more affordable, reduce pressure on government interest payments, and spur business investment. Yeah, you bet your, butt that is. But there is a genuine downside that should also be considered. Lower rates also risk fanning the flames of inflation. Even now, the devastation from the last 5 years is very obvious to all, and it's hardly gone. The CPI came in fairly hot last week. In 3 to 4 years, the prices of everything shot up. You know the story with housing prices, double in many places. You feel it every time you go to the grocery store. Meat has again taken an upturn. Groceries in general are up nearly 40% in these strange years. They are not going back either. We are stuck, and the American household is squeezed as never before. Groceries are particularly painful. You feel it every day. And then he's got a couple of very interesting charts here. Obviously, this chart is just on the price of groceries. You can see how they have dramatically gone up on certain categories. Again, we all understand that. But then we have here the PPI. You can see the PPI still hovering around 2.7%. But as I said, it has dramatically come down. We're coming back down here and then pop back up a little bit. And still hovering around that 2.5% range. If I will say this, if the PPI sticks around 2.5%, that's not bad. I would take that. That's fine. If we reduce rates and PPI still hangs in around 2.5%, okay, I'd live with that. That'd be fine. And then he goes through a number of other charts here. He gets down to the M2 money supply. And then he goes into the M2, where things are at. Government has reduced the distribution. Now, what is this? Oh, this is sticky price, consumer price index, less food and energy. You can see that that's up to, running into about 11% on that. So then he ends here by saying that this is the danger. The Trump administration needs to put a priority on killing inflation. The rumors of its death were greatly exaggerated, and the price pressure is already clawing its way out of the coffin and through the dirt. Beware. This is no time to lower rates. It's in the long-term political interest of the Trump administration to generate economic growth the old-fashioned way, through saving and investment, not fiat money. The second wave is not here yet, but there are already reasons to be on the lookout. So, and again, I don't necessarily disagree with Jeffrey here. However, I would say that there is a but here. Do I think that interest rates could be lowered by, say, a percentage point? 4 quarter point rates. You take the rate down to the federal funds rate down to 3.25 to 3.5%. That could possibly help to get mortgage rates back down. Again, a lot still depends on the bond market, our national debt, yields, especially the 10-year yield. Is that, can we get that back down, a little bit more, maybe into the threes? Maybe, but that's still going to be tough. But, will that help? I think it absolutely will help. But again, there are other considerations, other thing to think of. But is the question here is lowering the rates by, say, a point, is that going to spike the interest rates? Is that going to spike inflation back up? I don't believe it will, but I think it will help in a lot of other areas. I think if the rates can get back down into the fives on mortgages, I think you would then the housing market would start to move. You start to see more of the economic growth. You see more stuff starting to happen, make it easier for the government to service the national debt as well as refinance via the bond market the existing debt through the treasuries that has to go out. So there are a lot of positives that could come through this. Now, I will say this, President Trump has mentioned that he'd like to see rates come down 200, 300 basis points. I think that would be a monumental mistake, because now you're basically going back to almost ZERP. You're going back almost back to zero interest rate policy. We do not want to do that. The Fed doesn't want to do that. I would not want to do that. I think that would be a horrible thing to do. I think we have to. In order to put the economy back to where it should be, you're going to have to accept the fact that rates are just simply going to be higher. The rates are going to be 4%, 5%, 6%. That's the range that rates are going to be in from now. Like we may never see rates back down at 3%, 3.5%, 3.75. Like that might prove to be a once in a lifetime thing. Hopefully it'll prove to be a once in a lifetime thing, because I think if we do see rates like that again, that means that basically things have totally collapsed, and we don't want that. But all I'm saying is, do I think that there is wiggle room in there, so to speak? Is there room in there to lower the rates where you're also not, causing a spike up in inflation? And I believe the answer there is yes, absolutely. Do I believe the Fed can reduce rates, which will help the economy? It'll help the government. It'll keep things moving along in a much better fashion. And I do not believe that this spike up. And here's the other big thing. I'm going to go back to the debt clock here for a minute. Here's the big thing here. You see this $2 trillion annual budget deficit up here in the left-hand corner? If you can begin to get that number back to even, if you can begin to get back to a balanced budget, if you can cut that down by 500 billion, a trillion, 1.5 trillion, 2 trillion, if you could get that number severely back down, you will basically crush any possibility of inflation spiking up, because you are reducing the spending from the government. Forget the tariffs. If you could get the spending back under control, if you could begin to reduce that government spending, you will crush any chance that there will be a massive spike up in inflation. Okay, because even if you do get these tariff price increases, the tariff price increases cannot in and of themselves do enough damage that the government printing, the government spending, that is what drives inflation. That is what spikes inflation, is the government spending. That is what needs to get under control. All right, let's see here. So let's get back to, all right, so now let's look at another interesting thing here I want to show everybody. So Home Depot, cautious about renovations rush despite tax cuts, talk of a rate cut. So it's always kind of interesting. I always look at Home Depot. I always say that there are certain things in the economy that simple things that you can look at to get an idea of how are things going generally, right? So if you're looking at the Home Depot and Lowe's, if you see them doing really well, Home Depot's killing it, they're selling over, that usually signals to you that the home renovation market is doing really good, which means real estate's probably doing very good. Homes are probably selling, homes are getting renovated, additions are getting put on, things are probably pretty good. And so fast food is another one. If you're seeing fast food doing really good, that's another indicator that, yeah, consumers are probably doing okay out there right now. We're going to look at an article toward the end of the night, hopefully, if I can get to it, on McDonald's. And we're going to, like I said, we're going to look at some interesting things here with good old Mickey D's. But let's continue here with Home Depot for just a second, because I want to get into another article here related to Home Depot, that another interesting, conversation here, if you will, on the inflation front. So economic uncertainty has deterred homeowners from doing large renovations, though the outlook may be getting clearer now that a tax policy is in place, Home Depot CEO Edward Deckard said. Still, the home improvement supplier said its forecast assumes there won't be a resurgence in projects that require borrowing. Relatively high interest rates remain a hurdle. So Home Depot may have reason to be more comfortable financing renovations, or I should say homeowners may be more reasonable, but Home Depot isn't counting on a shift in their mindset. Some of the economic uncertainty giving homeowners pause faded when the federal government enacted a tax policy. Home Depot CEO Ted Deckard said while discussing second quarter results on a conference call Tuesday. But in the year ahead, Home Depot assumes there won't be any change in the volume of homeowners undertaking the type of large renovations that require financing. Our customers still tell us that the rate environment is giving them pause on larger remodeling projects. Financial market participants expect that the Federal Reserve will soon start lowering interest rates, hopefully, which could make borrowing more attractive for those waiting to remodel a home. So this gets back to the point of what we're talking about, of rate cuts, again, spurring home improvement. But what the Home Depot CEO is telling you right here is that, hey, look, unfortunately, the interest rate environment right now is making it very unattractive. And we're not expecting much to change in the short term because of where the rates are currently at. Now, give me a second here. I want to pull something off, and I want to show you guys another article here. All right, so let me show you this here for a second. And don't know if I can make this a lot bigger here, but let me see if I can, because I'm just doing this. I had to show, unfortunately, I had to show this in like a Word document. But anyway, like I said, I'll read through this to you guys. So basically, this is by Aaron Back, who is basically a journalist over at the Wall Street Journal. And he wrote this little piece called "Tariff Inflation is Just Starting." Now, he says in May, Home Depot executives told investors that they plan to hold the line on prices despite tariffs. They even boasted that their ability to do so represented a great opportunity for us to take share. Fast forward 3 months to their latest quarterly report, and the retailer now says there will be some modest price movement in some categories. Well, what changed? Well, William Bastek, Home Depot Executive Vice President of Merchandising, told analysts, now some of the imported goods, obviously tariff rates are significantly higher today than they were when we spoke in May. That actually isn't obvious. With all the back and forth threats and last minute deals, investors could be forgiven for not having a clear picture of what Home Depot's import bills look like now compared with 3 months ago. But this highlights a broader point. With all the uncertainty over tariffs, it has broadly made sense for companies to hold the line on pricing. After all, why upset customers with a price hike over a tariff that could go away in an instant? Yet companies can't sit on their hands forever. On Thursday, investors will be looking for more clarity from the big boy of retail, Walmart. Unlike Home Depot, it admitted last quarter that some price hikes were inevitable, but told investors to wait for their second quarter update for fuller guidance. Economists at Goldman Sachs, in a widely discussed note this month, shed further light on what's happening. Looking at the first wave of tariffs against China back in February, they found that U.S. companies initially absorbed the costs. So companies absorbed those initial tariff costs, but now they are passing on more to consumers. Specifically, they found that around 36% of tariff costs were passed on to consumer prices after 3 months of implementation, and around 67% were passed on after 4 months. So this makes sense. Besides waiting for clarity on tariffs, it also takes time to negotiate new prices with suppliers and customers. and there have often been opportunities to stock up on goods before Trump's declared deadlines. But the longer the tariffs stay in place, the more they will bleed into consumer prices. The implications are concerning. This means the Liberation Day tariffs declared in April and negotiated over the past several months, as well as sector-level tariffs on things like auto, steel, and so on, aren't being fully felt yet. Goldman's economists figure that consumers had absorbed just 22% of total tariff costs through June, but this will rise to 67% by October. So in short, don't take too much comfort from the relatively subdued inflation seen so far. The real tariff bill is yet to arrive. So, and then there's a very interesting chart here. I know that it might be a little small here for people that are looking at it, but basically it says, so the dark blue line is June of 2025, where the light blue line is October of 2025. So you could see up to this point, U.S. businesses have absorbed the vast majority of the tariff costs. The foreign exporters had absorbed a lot of it, but now they're beginning to pass it on. And they're saying that the U.S. consumer has absorbed only about 22% of this cost so far, but in the months ahead, they're likely to absorb 67% of this cost. So again, very interesting to note. And I think a lot of what's said here in this article was very spot on. However, I would add some caveats. Number one, I think that what they don't mention here is that this spike increase is only going to be in certain things. It's not going to be like across the board in everything, right? It's going to be on certain items that, again, all depends on the negotiations and how things worked out, how things, settle in at the end of the day between customers and suppliers and distributors and the wholesalers. And, all that takes a little bit of time to flush out, right? So yes, will you see some price increases? Undoubtedly. Will it be catastrophic? No, I think, you might see something, maybe it's $13, maybe it goes up to 14, maybe it goes up to 15, okay. Do we like it? No. Is it the end of the world? No. So some of this is, I think, a little bit over dramatic. I think it's a little bit overblown that like, oh, hey, doomsday is still upon us. Doomsday is still upon us. And I don't see that. And then you also have to understand, and this is where I get into McDonald's, and this is why, and you know what? I'm going to jump to the McDonald's thing. Let's take that. Let's get out of that right here. I'm going to go back. Give me a second here because I want to go back. All right, let's come back to this for a second. All right, now let me find. All right, here is the Wall Street Journal. This is the article with McDonald's, and I think this will illustrate some of my point here, what I'm trying to make. So McDonald's to cut combo meal prices after convincing franchisees. So the burger chain working to improve its affordability, wait for it, after customers recoiled from escalating restaurant menu prices. Oh, wait a minute. So you mean they tried to increase the prices and then the consumers pushed back and then they said, oh, wait a minute, we got to bring those prices back down because, our sales are slowing and customers are not happy. Oh, really? You don't say. So McDonald's is lowering the cost of its combo meal after consumers were left sticker shocked by Big Mac meals that climbed to $18 in some places. I don't know if any of you guys saw there was a lot of videos on X, different people around the country complaining about the cost of Big Macs and stuff like that kind of was out there for a few weeks. But the Burger Giant's move follows weeks of discussions between McDonald's and restaurant operators, including the company offering financial support if franchisees agree to drop prices, according to people involved in the discussion. So after pitching operators on the plan, McDonald's and its U.S. franchisees agreed to keep the cost of 8 popular combo meals 15% below the sum of the individual item prices, according to the company materials viewed by the Wall Street Journal. The chain also will run $5 breakfast and $8 Big Mac and nugget combo meal specials later this year, marking them as extra value meals. The move is part of the chain's push to restore its reputation for affordability. There you go, which has taken a hit with cash-strapped consumers. McDonald's has said that its new McValue deal meal is helping, but many consumers still feel the chain's menu prices overall are too high. Customers are telling us they need more of the everyday value and affordability that defines the McDonald's brand, said Joe Erlinger, head of McDonald's U.S. business, in an internal message following the company's earnings report earlier this month. So, and then you can see here, it's got a chart here that looks at New York, at San Francisco, Los Angeles, Chicago, Philadelphia. So you can see that, the Big Mac deal, they have brought the prices down a little bit versus kind of like the a la carte menu. But again, this just goes to show the point of what I was just talking about there with tariffs. And that is this, that again, will you see some price increases down the road? Yes. Are some of those prices going to stick? No, probably not, because you're going to get pushback. People are going to say, forget it. Like, I'm just not buying it. I'm not buying it. I'm not paying for it. Forget it. So the company is going to have no choice. They're either going to have to say, okay, we're going to have to lower our prices back to where they were, or our sales are going to basically plummet. Our sales are going to go down, who knows, 15, 20%, whatever. But again, the tariff issue is this, will we eventually see some price increases? Yes. My point is this: is it going to be across the board, like on everything, everywhere? No, it's not. Are some companies going to try to pass on maybe a little bit too much of this cost to the consumer? Yes, they are. Are they going to get backlash? Are they going to pay the price for that? Yes, they are. And it's going to put them into the situation that McDonald's finds themselves in right now. So, and again, I think a lot of companies should heed the example of what's going on with McDonald's right now, so as they do not make this mistake in the future. But again, getting back to the real issue of inflation, it's government. It's not the tariffs. Okay. The tariffs is fear porn that's just out there for the media and the establishment to sit there and basically say, oh, the tariffs are going to wreck the economy. We are already seen, guys, the tariffs are not going to wreck the economy. The tariffs are bringing in a tremendous amount of revenue that is going to dramatically help us, which I'm going to show you in a little bit. The threat of inflation that we have to worry about is the government spending, and we have to cut the government spending. I will preach this until I'm blue in the face. The government spending has to be cut. We have to get back to a balanced budget. We have to begin to reduce the national debt. That is what will bring inflation back down. That's what will break the back of inflation. It's the government spending. It's like the old saying, it's the economy. It's government spending, stupid. That's what has to come down. That's what has to be broken. So, all right, let's keep going here. So, let's move on to our next thing here. So Besant says that interviews for the incredible group of, maybe you should call it the big, beautiful group, the one big, beautiful group of potential Fed chairs, will start after Labor Day. So Treasury Secretary Scott Bessent said he will begin interviewing candidates for Fed chair soon as the White House whittles down what has suddenly become a crowded field of 11 candidates, including Rasputin. Again, it's my inside joke from we had to be watching last week. In a CNBC Squawk Box interview, Bessent repeated the administration's desire for easing, saying it would help the moribund U.S. housing market. Well, we'll see. Treasury Secretary Scott Bessent said on Tuesday he will begin interviewing candidates for Federal Reserve Chair as soon as the White House whittles down what has suddenly become a crowded field. In a CNBC Squawk Box interview, Bessent confirmed the race to replace current chair Jeremy Powell is between 11 candidates, an array that includes past and present central bank officials as well as economists, a White House advisor, and a few Wall Street market experts. In terms of the interview process, we've announced 11 very strong candidates. I'm going to be meeting with them probably right after Labor Day and to start bringing down the list to present to President Trump. It's an incredible group. Again, a lot of people in here. So the list is believed to contain current governors Mickey Bowman, Philip Jefferson, and Christopher Waller, Dallas Fed President Lori Logan, White House economist Kevin Hassett, and former Governor Kevin Warsh, strategist Rick Reeder of BlackRock, and David Zervos, a.k.a. Rasputin of Jeffries. also are part of the group, as well as economist Mark Summerlin, former Governor Larry Lindsey, and former St. Louis Fed President James Bullard. So again, quite the group. I don't know. I'm not so crazy about a lot of these individuals. I maybe would have liked to see somebody different, but we'll see. But let's look at this too. So, according to a CNBC survey, Hassett likely to be Trump's pick for next Fed chief, though Warsh is more qualified. So, according to the CNBC survey, so President Donald Trump will tap his top economic advisor, Kevin Hassett, to be the next Fed chair, according to respondents to a special Jackson Hole edition of the CNBC Fed survey. But when asked who the president should pick, former Fed Governor Kevin Warsh took the number one spot. Survey respondents see 2 rate cuts this year from the Fed in September and December, but also high inflation. So again, keep in mind who was taking the survey, who the survey participants were. It was all the Fed people and other central bankers over at the Jackson Hole Summit. Not a more broader gathering, if you will. And of course, Kevin Warsh would be their pick, because that guy is, I hope that Kevin Warsh does not get the job, because he will be, he'll be Jeremy Powell 2.0. So we don't need that. Now, Kevin Hassett, is he the answer? I don't know that he's the answer either. I mean, we'll have to, I don't know. We'll have to see what happens here. Here's a picture. Here's Kevin Hassett right here. Yeah, I got to say that this guy, like this picture, not really striking me as like the alpha male here who's going to go in and really, give it to that group think at the Fed. I just, I could be wrong. I mean, maybe Kevin is more of a, bad mofo than I know, but we'll see. We'll find out. Like I said, we'll keep tabs on this though, and obviously, as these interviews play out, we'll get in there, and I will bring that news to everybody. This Fed governor, however, Lisa Cook, is in a lot of hot water at the moment. So Trump calls for Fed Governor Lisa Cook's resignation over mortgage fraud allegations. So the federal housing finance regulator Bill Pulte accused Cook of mortgage fraud. So President Donald Trump urged Federal Reserve Governor Lisa Cook to resign following allegations of mortgage fraud. Cook must resign now, Trump said in an August 20th Truth Social post. His statement came shortly after Bill Pulte, chairman of the Federal Housing Finance Agency, posted on X a criminal referral letter dated August 15th to Attorney General Pam Bondi and Special Attorney Ed Martin. Pulte alleged that Cook may have committed mortgage fraud by falsifying bank documents and property records to acquire more favorable loan terms and lower interest rates. The letter alleges that she may have misrepresented the status of 2 properties, one in Ann Arbor, Michigan, and another in Atlanta, as her primary residence in 2021. Both homes were identified as her main residence within weeks of each other. According to the letter, Cook also listed the Atlanta-based property for rent, despite stating in a mortgage document that it would be her primary home. While the property was listed for rent in 2022, a review of Mrs. Cook's federal government financial disclosures for calendar years 22 and 23 indicate that she has not disclosed any rental income tied to this address, Pulte wrote. Cook stated that she learned about Pulte's accusations from the media and does not plan to resign. I have no intention of being bullied to step down from my position because of some questions raised in a tweet. Cook said in a statement to the Epoch Times, I do intend to take any questions about my financial history seriously as a member of the Federal Reserve, and so I am gathering the accurate information to answer any legitimate questions to provide the facts. So, this is an interesting one, and we're going to look at an article here in a second as to, what do some of the people in the Fed think about this story right now. So, yeah, I think this is an interesting one because, if she did in fact do this on her mortgage application, if she did in fact misrepresent that is a serious thing. That's not a small thing. Now they talk about, just so people understand, they talk about her financial disclosures. Well, the financial disclosures are not tax returns. And I would basically say, yeah, let's see the tax returns. You said on your financial disclosures that you didn't receive any rental income, but what do your tax returns say? Because that is the ultimate arbiter here of what is really happening in her situation. Now, I would say if you get her tax returns and her tax returns show that she was renting out those houses for the majority of the time and making rental income over the last 2-3 years, I think that's a big problem for her. I think that's a major problem for her. Now, if her tax return showed that she wasn't really making any rental income on there and that she didn't really rent them out that much over the last, 3-4 years, then it gets a little murky, because it's kind of like having a secondary residence, right? Where you have like a beach house where you do own it, you do use it. Maybe half the time you use it, half the time you rent it out. Maybe during like the summer season, you rent the thing out a little bit. So in that kind of world, that's what I mean by this could get a little murky, right? Um, but again, if you can show, or if you could prove that she basically did this in a very misleading fashion to get better interest rates, because again, I'll give you an example, right? For today. So say I was coming in to get a mortgage. I wanted to get a 30-year mortgage on a house today. Rates probably at, I don't know, 6.5, right? Something like that. So I say, hey, it's my primary mortgage. I'm putting 20% down. I need an 80% first mortgage. Give me the best rate you got. Okay, it's 6 points. Let's say it's 6.6%. Okay, 6.6%, fantastic, whatever. But then if I came in and I said, hey, listen, I'm going to buy this single family house over here, and I'm keeping it as an investment property because I'm going to rent it out. What's the interest rate on that going to be? Probably 7.5%, because again, there's more risk on that. They're probably going to say, oh, and they're going to say, oh, by the way, you're probably going to have to put down 25% at a minimum, maybe even 30% to make us happy. So the down payment's going to be a lot more. The interest rate's going to be a lot higher. Why? Because it's an investment property, and there's more inherent risk in an investment property as opposed to your primary residence. So again, just looking at that and thinking about that, again, I think the tax returns are going to be that's going to be the tell of the tape, so to speak. And we'll see. We'll see what happens here with this. But and again, it's a wild thing, because here's the other thing: is this unique to Mrs. Cook? At the Fed? No, this is not unique just to her. This seems to be based on other reports with some other politicians, Adam Schiff and some other Letitia James, other people that we've seen in the news lately. It seems to be like a lot of people in DC have been running this same scam. And a lot of people in DC are guilty of doing this very same thing, which is kind of wild. And it shows a very big systemic issue. So, and I think it leads to perhaps some broader questions. If you have a bunch of politician and government employees that are running around doing this, what's going on in DC? Like, who are the banks that are doing this? Who are the mortgage bankers that are putting this through? And are they doing this on purpose? Like, are they being told that, hey, you know what? Just fill out the application like this. Don't worry about it. We're going to take good care of you. Is this some kind of a you scratch my back, I scratch your back, tit for tat kind of thing? Maybe not outright corruption, but, in a way, some type of bribery going on there. Like, I mean, again, I think that this whole situation and other instances that you're seeing around DC just lead to a much more disturbing, I think a much larger, much more disturbing picture. So I just, again, I'll just kind of leave it at that. But she is definitely in some hot water here, and we will see how this one plays out in the coming weeks. So. And then what do some of the current and former Fed officials, what are they saying about this? So current and former Federal Reserve officials have offered their thoughts about the Trump administration's recent mortgage fraud allegations. Former Boston Fed President Eric Rosengreen told CNBC on Friday that until there are some facts out, I don't think people should draw any conclusions. While others, such as Cleveland Fed President Beth Hammack, called Cook an outstanding economist and a person of high integrity, President Donald Trump has said that he will fire Cook if she does not step down as Fed governor. Let's see here. I just want to see if there was anything else in there. Again, Beth Hammack, I know Lisa Cook to be an outstanding economist and a person of high integrity, and I think it's critically important that the Fed maintains its independence on monetary policy so we can ensure great outcomes for the American public. What does that mean? I don't know. It just sounds like a bunch of gibberish. And let's see if there's anything else in here. Yeah, I mean, just it immediately goes to this kind of nonsense of safeguarding independence. I don't think this, to me, this doesn't really have anything to do with safeguarding independence. If she broke the law or if she did something, I will say this, people may remember about a year or so ago, a bunch of Fed governors got caught doing insider trading. Remember that little gem that came out? Yeah, they all should have gone to jail for that little gem. But instead, a couple of the Fed governors, they conveniently retired real quick. And of course, Jeremy Powell was also questioned in that. And they quashed that real quick. I still have a lot of questions around there as to what exactly Mr. Powell was doing there. But again, anytime that somebody at the Fed gets in trouble for anything, it immediately goes to this narrative of like, oh, well, if you're investigating people at the Fed, we have to keep our independence, and we have to do this and we have to do that. It's like, no. If people at the Fed are committing crimes, if people at the Fed are doing things that they shouldn't be doing, do I want and expect them to be called on the carpet? Yes, you better believe I want them to be called on the carpet. Yeah, I just like anybody else, right? No one's above the law, right? Remember that saying? We've heard that one a lot. Yeah, no one's above the law, okay? If they're doing things that they shouldn't be doing and they get caught for it, do I want them to be penalized? Yeah, I do. And you know why? Because you and I would be penalized for that at the end of the day, no doubt. No doubt you and I would be in hot water for some of this stuff. So yeah, what's fair is fair at the end of the day. So, all right. Well, enough on that. Another article here, Federal Reserve says clarity on tariffs will take some time. So the board minutes highlighted that uncertainty remains about timing, magnitude, and persistence of effects on this year's increases in duties. So again, it's going to take a while to sort out the impact of President Donald Trump's tariffs on inflation. So members of the Federal Reserve Board are not in unity on whether it's time to introduce a rate cut. Minutes from the July meeting indicated, which we talked about a little bit earlier. So, but, again, just more of it's going to take a while for us to know what the deal is. So, all right. Let's look at a couple of economic indicators here real quick before we get into some tariff news. So July home sales rise as prices approach an inflection point. So sales of previously owned homes rose 2% in July, according to the National Association of Realtors. There were 1.55 million homes for sale at the end of July, an increase of 15.7% from the same month last year. Inventory is now at the highest level since May of 2020. And it's clearly taking the pressure off of prices. Yes, so we are seeing actually prices decline in some areas of the country. Other areas like the Northeast, prices are still going up, but in some areas like the South, the Southwest, central parts of the country, the western parts of the country, we are in certain pockets, we are actually seeing prices decline a little bit. So it's good to see that July home sales pick up. It's good to see inventory beginning to pick up a little bit because we absolutely need that. Consumer spending slows amid labor market cooling and tariff uncertainty, according to Fitch. Household spending growth fell sharply in the first half of the year, with Fitch flagging a stagflationary risk. Now, what is stagflation? Well, stagflation is where you have persistently higher interest rates and you have a very weak economy, where the economy effectively gets kind of stuck in neutral because you can't get any economic growth. Unemployment is high, inflation is high, thus the stagflation economy. And that's what we saw in the 1970s. I believe Had Donald Trump not gotten elected, we absolutely would have gone in. We'd be sitting right now in a massively stagflationary economy. We would be sitting in that right this very minute. However, with Donald Trump getting in there, changing the policies, doing a lot of the things he's doing, I do not believe that we're not in a stagflationary economy, nor do I believe that we are going to be in one. But to be fair, this article, so U.S. consumer spending slowed sharply in the first half of 2025 as a cooling labor market, higher tariffs, and volatile equity markets weighed on household confidence, according to a new Fitch ratings report and government data. The pullback raises concerns about whether the resilience of American shoppers, who account for roughly 2/3 of gross domestic product, can continue into the year-end holiday season. Fitch's latest consumer health monitor, released August 21st, showed that household spending growth decelerated to 0.5% in the first quarter and 1.4% in the second, down from nearly 4% in the second half of 2024. So spending on durable goods, a bellwether of consumer confidence in big ticket purchases, fell by an annualized 3.7% in the first quarter. Fitch attributed the decline to trade policy uncertainty and stock market volatility, which dented household sentiment. The ratings agency expected consumer spending to average just 1.8% annually in 25 and 26, a full percentage point below last year's pace, and warned of a potential stagflation scenario. And again, I don't know. I think some of this is a little ridiculous. Declined due to the trade policy uncertainty and the stock market volatility. I don't know. Last I checked, the stock market's at all-time highs, man. The stock market has been killing it all year long. I'm sorry, I didn't stock market volatility. Haven't really seen a whole lot of that. And as far as the trade policy uncertainty, I got news for you. The average person, okay, couldn't tell you anything about what's going on in the tariffs because they just don't care. They're not. It's not important to them. It's not on their mind. It's important to the people at Fitch who have to write this stuff. But again, like the average person is not running around every day going, oh my gosh, the trade policy. Oh, the trade talks aren't going so well. Oh my gosh, what are we going to do? Like, no. No, that's not happening. Okay. Regular people are worried about what's my Netflix bill? What's my cable bill? What's my internet bill? What's my energy bill this month? What's my rent? What's my student loan payment? Okay. That's what average everyday people are worried about. So I think this article, again, I wanted to share this because, again, I wanted to report on the consumer spending. So we are seeing a little bit of slowdown in consumer spending. Sure, no doubt. But here's the bigger thing. Are we seeing a collapse in consumer spending? No, we're not seeing a collapse in consumer spending. Sentiment continues to kind of go up and down a little bit. It's maybe not as great as what we will see, but hopefully, again, you just had the one big beautiful bill pass. You had a lot of tax incentives that should be kicking in here over the next 6 to 12 months. You have to give some of that time a chance to kind of work its way in. If interest rates come down, things continue to improve. I think that starting next year, you are going to begin to see a massive pickup in the economy. Remember, go back to Trump's first term in office. Remember what happened, okay? We saw a very, very similar thing. 2017, he comes in and he says, you know what? A lot of these trade deals that we have with these countries, they stink. And I'm going to go and I'm going to renegotiate them, okay? And I'm going to cut your taxes. And I'm going to do a lot. I'm going to cut regulation. I'm going to cut taxes. We're going to fix a lot of this stuff, okay? What were people saying in 2017? The same garbage that they're saying now. Oh, he's going to blow up the economy. Everything's going to be horrible. Everything's going to be going bad. And then you know what happened? He went in, he renegotiated the trade deals, and maybe they weren't perfect. Maybe a lot of the deals weren't perfect, but they were 100% better than what we had. And I think that's the point that a lot of people missed. What he negotiated was much, much better for the country as a whole, And the tax cuts and everything, the deregulation, as that stuff started to kick in, what happened? 18, the economy started getting better. 19, the economy absolutely took off. 2019 was one of the best economic years this country has ever seen. And, if it wasn't for the pandemic in 2020, no doubt 2020 would have been another incredible economic year, but obviously that wasn't to be. But we are seeing the same things unfold. Give this another year, give it another 18 months, and I think you will see this economy humming. But a couple things have to happen. We need to see rates come down a little bit. We have to see that. That has to happen. You need that to go along with the deregulation, the tax cuts, everything, all the other things that go in. You got to have these rates come down a little bit. That's what we need. Okay. U.S. manufacturing surges to 3-year high as demand strengthens and hiring picks up. Oh, well, would you look at that? How about that? Surge driven by exports. Wait for it. Let me say it again. Surge driven by exports. That meaning companies in the U.S. making stuff and shipping it to other countries. And increased demand for domestic U.S. factory goods. Oh, look at that. Would you look at that? The United States manufacturing sector activity shot up to a 39-month high in August, driven by a surge in domestic and export demand for U.S. factory goods, boosting hiring while putting upward pressure on production costs and selling prices. So S&P Global reported on August 21st that overall U.S. business activity, including both manufacturing and services, grew at its fastest pace so far this year in August, pushing job creation to one of its highest rates in 3 years as businesses rushed to hire workers to meet soaring demand. Companies across both manufacturing and services are reporting stronger demand conditions, but are struggling to meet sales growth, causing backlogs of work to rise at a pace not seen since the pandemic-related capacity constraints recorded in early 2022. Chris Williamson, chief business economist at S&P Global Market Intelligence, said in a statement. Output growth over the past 2 months saw its strongest back-to-back expansion since the beginning of 2022, with U.S. factories showing a market acceleration in production after a slowdown in July. Overall output, counting both manufacturing and services, has now grown continuously for 31 months, adding to signs of a strong third quarter. The data indicate the economy is growing at an annualized rate of 2.5%. Up from 1.3% earlier this year. Many manufacturers reported better sales and demand conditions, with output getting an additional boost from renewed inventory building. Stocks of finished goods soared at their fastest pace since S&P Global began tracking the measure in 2007. The inventory jump was fueled by a combination of expectations of rising demand and inventory building amid concerns of supply shortages and future tariff impacts. Inflationary pressures, it says, did rose in August, both in terms of input costs and selling prices. So again, we'll see what happens there. But again, this is great news. It's great news. And once again, it shows you that the strategy of the Trump administration on tariffs and on these trade deals is working. This is just beginning to see this surge in manufacturing. Believe me, give this 2 more years. Wait until all these trade deals kick in. What people have to understand is that this is the effect of what's going to happen. For people that say that manufacturing, manufacturing will never come back, it'll never be what. Maybe it doesn't fully come back. Like maybe we don't get back to the days of the days of yore of the 1960s, 1970s. But can it come back? Like, can we see 30, 40, 50% growth in manufacturing? Yes, we absolutely can. And we will, because what will happen is that the tariffs will protect these American jobs, and employers will hire more people knowing that the tariffs are there protecting the industry. That's what it's all about. If the industry is protected by the tariffs, okay, the American employers will keep their jobs. The reason why all these manufacturing jobs left is because U.S. presidents in the past did not use tariffs to protect these industries. Therefore, foreigners, i.e. Japan, China, Europe, they were able to undercut the U.S. worker, okay? And thus a lot of companies said, well, hey, we might as well ship the jobs overseas because it's cheaper for us to do it that way and then send the product back in. And that's what happened. These presidents would not use the tariffs to protect these industries. And now you're seeing a complete reversal of that. And so again, you're going to see this continued surge in manufacturing, which is going to be a beautiful thing to see over the next couple of years. We'll see that. So, okay, home values and incomes rise faster than household debt, studies find. So overall, it's very, very positive. So Bankrate financial analyst Stephen Cates said. So Americans are deleveraging as both home equity and income are growing faster than debt levels, new studies show. Again, some more good news here. On August 13th, report by Bankrate, a financial analytics firm, shows a dramatic increase in home equity in most states. West Virginia led the pack with an average increase of 450% since 2020, followed by Oklahoma, 431%, Connecticut, 297%, Kansas, 234%, and Illinois at 217%. Americans have taken on more debt recently. The Federal Reserve reported that total household debt increased by $185 billion to $18.39 trillion in the second quarter of 2025. On average, however, Americans' mortgage debt relative to home values has been falling, Bankrate reports. Only the District of Columbia and Louisiana showed a decline in home equity levels, falling by 38% and 22% respectively over the past 5 years, according to the study. Alaska showed the smallest level of home equity appreciation at 17%, followed by North Dakota at 19% and Colorado at 48%. The total value of mortgaged homes nationwide has risen fast by over $10 trillion in the last 5 years, much faster than mortgage debt. The report reads, Americans' mortgage debt relative to home values fell significantly over the past 5 years, increasing the wealth of those who own homes. On a national level, the average home loan-to-value ratio in 2020 was 82%. It's now 70%. Bankrate financial analyst Stephen Cates told the Epoch Times, overall, it's very, very positive. So we're seeing a lot of home equity being built into a lot of houses as home prices have dramatically inflated over the last 5 years. That's both good and bad. That is a double-edged sword. On the one hand, that's really good. On the other hand, housing prices have got ridiculously expensive. Home affordability has dramatically decreased. When a lot of these boomers are going to sell their house here in the next 5 or 10 years, who's going to buy these houses? If a lot of these houses in a lot of areas are now, houses that a few years ago were, $500,000 are now $700,000 or $800,000. That puts a major crimp on home affordability. I mean, you've got to be making a lot of money every year to be able to afford an $800,000 house. And how many people out there could do that? I think that is a very big, legitimate question. So again, while the home equity is nice, you ask the question, could you at some point, if you do potentially start to see home values decrease, and now that home equity starts to shrink a little bit, what does that look like? I don't know. We'll have to see. I mean, like I said, overall, I think the tone of this report is positive, but I still think there's some concerns there. I think there's still some concerns on the horizon. So, okay. So before I get into all of the tariff news, and I had a bunch of stuff here I want to share with everybody, this is the time of the night where I like to talk about the 5 episodes that I put out this week. I also like to give you guys the economic indicators for what's coming out this week. And then I also want to give you guys a bunch of banking news. So, give me a minute here as let's go and let's find the podcast. Okay, podcast episodes. So what came out this week? So we had episode 449, which was basically titled, Should Your Bank Consider Cloud-Based Lending Solutions? So this episode reviewed a blog post from PCBB titled, Why Cloud-Based Lending Solutions Could Be the Future. So, with the continuous increase in technology, regulatory requirements, and changing customer needs, should your bank consider moving to cloud based lending solutions? This blog post offered 5 ways in which cloud based lending solutions can help to improve your internal operations and customer experience. They included: 1, enhanced accessibility; number 2, improved operational efficiencies and cost savings; 3, increased security; 4, better risk and compliance management; and 5, enhanced innovation and future readiness. So, very interesting topic here in terms of the cloud-based lending solutions. Could this be the future of lending? Maybe. Should banks be looking at this and considering this stuff? Yes, I think they should absolutely be looking at this stuff right now. Then on Tuesday, I put out episode 450, which was Does Your Bank Do Digital Onboarding? So this episode reviewed a blog post also from PCBB titled How Many Minutes Does Your Digital Onboarding Take? So digital only banks are landing 4 out of every 10 new checking accounts. So and when you think of digital banks, think of like Chime, PayPal, Block, think of that. Is your bank offering customers digital online account opening? And if so, how long does it take to open an account? What is the customer experience like? Some ways that banks can improve this process include: number 1, prioritize speed; number 2, investigate where your friction points are in your digital opening process; number 3, use instant digital verification; number 4, avoid detours; number 5, streamline instructions; number 6, conduct tests with real people; and number 7, have a strong mobile design. So again, another, I think, very interesting article looking at another, tech aspect in banking with the digital onboarding. It brings a very interesting question. I will tell everyone 2 big reasons why a lot of banks struggle with digital onboarding, if they offer it or if they don't offer it. And that is: number 1 is fraud. Massive amount of fraud. Again, for people, if you work in the banking industry, you understand this. If you don't work in the banking industry, I think you really don't understand how targeted. I mean, every bank in the country. I don't care how big or small they are. You are the target for fraud, man. Fraudsters are going to come after you, and any way they could try to get at the bank or steal from the bank or manipulate the bank, they're going to do it. And you would be, believe me, you would be blown away if you had any idea of how much fraud the typical bank. I just say like the typical billion-dollar community bank out there, which is a small bank in relative sense, but you would be blown away. Your mind would be blown if you really understood how much fraud that banks dealt with day in and day out. So fraud's a big concern. The other thing is regulation. It's just, there's so many, when you start talking about Chime and PayPal and Block and all this kind of stuff, they don't have the regulatory requirements that banks have. They just don't. Banks have to deal with CIP, KYC, EDD. I could go on and on. I could name you 10 different acronyms for 10 different rules and laws that banks have to comply with trying to attempt digital onboarding of some kind. So again, just something to be aware of. If you're ever questioning, well, why doesn't my bank do that? Well, there, now fraud and regulation. There you go. But I would also say too that at some point, some way, somehow, banks have to figure this out because customers do want to be able to do digital onboarding. Like they do want to be able to open accounts digitally online whenever they want to do it. And so, and I think that sooner or later, you've got to be able to figure out how to do that for your customers because that's ultimately what they want. So, okay, but moving on. On Wednesday, I did episode 451, which was titled Update to CECL Could Really Help Bank M&A. So this episode reviewed an article from Bank Director titled CECL Update Eases the Math for M&A. One of the problems with M&A transactions is called the CECL double count. This is where an acquiring bank must make additional provisions for non-purchased credit deteriorated loans. In other words, i.e. loans that have not experienced a credit loss as of yet. A buyer must set aside extra capital to cover expected losses on loans in addition to the credit loss expectations that have already been allocated, thus the double count. With FASB, the financial, what is FASB? It's not account. It'll come back to me. I forget the acronym off the top of my head. Financial Accounting Standards Board. Dang, I got it. There you go. FASB, Financial Accounting Standards Board. With FASB removing this requirement, depending on the size of the deal and your bank's capital position, this change could really help M&A transactions. It legitimately could. So we'll see what happens there. But, again, I've done other episodes. If people are curious to understand a little bit more about CECL and what that is, in terms of making sure that banks are putting aside proper loan loss reserves and things of that nature. I've done other episodes on that. You could go again to, you go to YouTube and search it out. There's probably a number of episodes out there on CECL you could look at. Then on Thursday, I did episode 452, which was called How Can Your Bank Get More Out of Its Tech Spending? So this episode examines an article from Independent Banker magazine titled, Is Your Bank Overspending on Tech? So how is your bank doing with its tech spending? This article lays out recommendations on how your bank can better control and get more out of its tech budget. Recommendations include, number one, address overlapping spending. Number two, avoid the pitfalls of unfit software. Number three, conduct a software audit. And number four, dedicate a team to oversee this work. And number five, innovate intelligently. Yes, so I think there's a number of great recommendations in there and a number of things that banks out there can do to control your tech spending. And then finally, on Friday, yesterday, I had episode 453 came out, which was called Crypto Bros Gone Wild. And this was part 28 of the crypto series. And in this episode, we reviewed an article from the Wall Street Journal titled Tequila, Drugs, and Torture, the spending binge of two crypto bros that ended behind bars. So this episode is the story of two crypto bros, William Duplessis and John Waltz, who started out with large dreams and made it big in the business world, only to have everything devolve into an alleged kidnapping scheme. So this was quite the story. And again, a little bit longer of an episode. I think that episode ran at about 23 minutes, so a little bit longer than a lot of my normal episodes. But like I said, I did that because I thought it was a very entertaining, very wild story that I thought a lot of people would really enjoy. So again, if you didn't get a chance to check out any of those episodes, please go check them out when you get a chance. And for anybody who doesn't know, I run basically the way that I have the format of the channel laid out is that I run new episodes every week, Monday through Friday. All the episodes premiere at noon. And the general time frame for the episodes is basically about 10 to 20 minutes in length, just because I like doing shorter episodes on a particular topic, usually things that I don't have time to cover in the live stream, or maybe something that I just want to give its own, kind of, dedication to, things like that. But I also put out a lot of different series. Like I've got book reviews. I do, movie and documentary reviews as it relates, if they relate to business or finance in some way. It's not just, I don't just do, general movie or documentary reviews. It has to be something that is, pop culture, but also is directly tied in some way into the financial world. Think like Wall Street, The Wolf of Wall Street, Boiler Room, Margin Call. Think of movies and things like that. That's the kind of stuff that I would cover. Like I did, there was a documentary on Big Vape that was on Netflix. Like I covered that. They had a couple of crypto, story Bitcoin on Netflix. I covered that. That's the kind of stuff that I would cover. And then obviously Lords of Easy Money series. I do a lot of interviews with a lot of different people that come out. So a lot of different things that come out during the week. And then on Saturday nights, for the most part, it doesn't. I don't always get to every Saturday night. Sometimes they're Friday nights, but for the most part, every Saturday night, this is, as you are watching, I do the live stream. So that's basically how I set up the content on the channel and how a lot of stuff generally rolls out. So okay, so those were my 5 episodes for the week. So what are some of the economic indicators that we have coming out this week? So on Monday, August 25th, we have building permits, new home sales, and we get the FOMC member Williams is going to speak. On Tuesday, August 26th, we get the durable goods orders, the CB consumer confidence, the 2-year Treasury note auction, and the API weekly crude oil stock. On Wednesday, August 27th, we get the 5-year Treasury note auction. On Thursday, August 28th, we get the continuing jobless claims, initial jobless claims, GDP, for the second quarter, pending home sales, the 7-year Treasury note auction, and then on Friday, August 29th, we get the core PCE price index, the goods trade balance, Chicago PMI, Michigan consumer sentiment, and the U.S. Baker Hills oil rig count. So a lot of economic data coming out this week. We got FOMC speaking, GDP numbers. We get the core PCE. Everybody will be all eyes will be on that. 2-year Treasury note auction, a lot of real estate data with building permits, and then some labor market numbers with initial jobless claims, continuous jobless claims. So a lot of stuff coming out and that end. So now, how about some banking news, right? So big news on the open banking front. So the CFPB releases new 1033 proposal on sharing consumer financial data, aka open banking. So the Consumer Financial Protection Bureau released an advanced notice of proposed rulemaking to collect information on how it should implement Section 1033 standards on sharing consumer financial data. Now get this, because you're gonna love this when you hear this. If you guys have heard me rant in the last few weeks about open banking, oh boy. So what's the background here? Well, the Section 1033 of the Dodd-Frank Act requires covered financial institutions to make available to consumers certain data relating to consumers' transactions and accounts upon request. However, they're not making it available to consumers. They're making it available to fintech companies. Okay, like it's not getting made available to you and I. It's getting made available to fintechs like Meta, like Google, like Amazon. So this new proposed rule, the new proposal seeks comments to inform its consideration for 4 issues related to implementing Section 1031. So the first one is, wait for this, who can serve as a representative making a request on behalf of the consumer? How about nobody? How about I don't want anybody. No one's going to be a representative on my behalf. This is nuts. The optimal approach to the assessment of fees to defray the costs incurred by a covered person in responding to a customer-driven request. So in other words, that is, the fintechs not only want your data, they want it for free. They don't want to have to pay for it. The threat and cost benefit pictures for data security associated with 1033 compliance. In other words, it's going to cost banks a blank ton of money to make this happen and to cover themselves, because they're going to use very insecure API connections to siphon the data out, and that is undoubtedly going to lead to some massive data breaches. You could bet $1 million on that one. And then finally, the threat picture for data privacy. Yes, you're going to expose your data, no doubt, absolutely. This is just what I just can't even believe this. And what is even more wild is the fact that, people are just so unaware of this. They're just so unaware of what open banking is, the 1033 rule. If I talked about last week how I spoke at an event with a crowd of about 60 people, and I asked the whole room, I said, hey, does anybody know what open banking is? No, crickets. Has anybody ever heard of the 1033 rule? No, crickets. Like, nobody is aware of this, and it affects literally everyone. It's going to affect everyone in this country. You need to learn and understand what the 1033 rule is. What is open banking? You have to understand this, because it's going to affect all of your data. Okay, so you have to understand this. And it just blows my mind that this is the stuff that they want comments on this, on who could serve as a representative making the request, and the optimal approach to assessment of fees to defray the costs incurred by a covered person. It's insane. Why are they doing this? Like, why are you doing this? But obviously, we're going to go through this comment period, and then we'll see what happens. So I will absolutely keep everybody updated on this, and we'll see where we go from here. So, okay, what else we got here? So mortgage rates level off. The rate for the 30-year fixed rate mortgage was 6.58% this week. That's pretty good. So when I said earlier 6.6%, I was like right on the money. That's great. That's good. Existing home sales increased in July. We talked about that. Rural Economic Index weakens. So the Creighton University's index of rural economic conditions fell to 48.1 in August after rising to 50.6 in July and 51.9 in June. ICBA supports inclusion of CDFI amendments in the defense bill. So ICBA said it supported 4 pieces of legislation aimed at strengthening community development financial institutions that are being considered as an amendment to the National Defense Authorization Act. I just got to say, this is a pet peeve of mine. I do not think any of this should be included on the National Defense Authorization Act. The National Defense Authorization Act has to do with the spending on national defense. It doesn't have anything to do with banking or CDFI or anything. I hate. It's just a pet peeve of mine. Like, I hate when bills get tacked onto much larger legislation. Like, that drives me nuts. I hate that. It's like, this is why, we need single spending bills. Okay. I can't stand these omnibuses, these massive CRs, continuing resolutions. I hate this crap. I hate it. And I hate when, like I said, the politicians, they use these bigger bills as leverage to, well, I'm not going to vote on that bigger bill unless you attach this CDFI thing here and vote on that as well. I get that's how politics works and all the horse trading and everything involved. It's just a pet peeve of mine. It just irks me. ICBA meets with FDIC chair on de novo banks. So senior ICBA staff and ICBA's de novo working group met with FDIC acting chairman Travis Hill to discuss regulatory challenges that de novo banks face. So the working group, which comprises de novo bankers from around the country, advocated lower capital requirements, streamlined applications, and tailored supervision that will increase de novo bank formation and lower the regulatory burden on existing de novo banks. Yes, love it. Hope that continues. The Fed's Michelle Mickey Bowman, asset tokenization offers banking industry opportunities. So Federal Reserve Vice Chair for Supervision, Michelle Mickey Bowman, said bank regulators are working to create a framework for digital assets within the banking system that will ensure safety and soundness while improving speed and efficiency. So that's good. ICBA and other groups, Congress must ensure new data privacy rules are not duplicative. ICBA and other groups told the House Energy and Commerce Committee that any proposed federal data privacy framework should ensure financial institutions already subject to the Gramm-Leach-Bliley Act are not subject to inconsistent or duplicative requirements. Okay. ICBA, others urge Congress to keep interchange amendments out of defense bills. So they want the CDFI stuff in, but they don't want this interchange amendments, right? So, like, how about none of this? How about we just vote on this stuff as it is? But anyway, I guess that's wishful thinking on my part. But anyway, so ICBA and other groups urge Congress to reject the Marshall-Durbin interchange legislation, formerly known as the Credit Card Competition Act, and a related commissionary interchange. The study proposed as amendments to the fiscal 2026 National Defense Authorization Act. Yes, I think this Marshall-Durbin interchange legislation that was known as the Credit Card Competition Act, I think that was very misguided from the beginning, and it should not be voted on, but we'll see. FDIC proposes changes to sign and advertising requirements. So the FDIC proposed amending regulations governing the display of FDI official digital sign and non-deposit signage. So I'll have actually an article on that in a little while. ICBA urging community banker grassroots letters on fraud. So the ICBA is calling on community bankers to use its newly published grassroots guide to submit comment letters on an ICBA-supported interagency request for information on mitigated payments fraud. Treasury requests comments on the Genius Act. So the Treasury Department issued a request for comment on its implementation of parts of the Genius Act stablecoin law. So see what that brings. FDIC urges feds not to finalize proposed revisions to the large financial institution rating system. So ICBA urged the Federal Reserve not to finalize the proposed revisions to the large financial institution rating system and framework for supervision of insurance organizations. ICBA said it strongly opposed the proposal, which invites safety and soundness issues by allowing large firms with a deficient 1 rating to be considered well managed, and by removing the presumption that a deficient 1 rating would result in an enforcement action, lowering the bar for large banks to be considered well managed, which will accelerate consolidation and exacerbate the problem of too big to fail institutions, de-emphasizing the governance and controls component for growth-obsessed large firms, many of which have previously demonstrated weakness in these areas. The Fed will sunset novel activity supervision program. So the Federal Reserve announced it will sunset its novel activities supervision program and return to monitoring banks' novel activities through the normal supervisory process. This is the thing that the ICBA was just urging against. Op-ed, it's time to pull the plug on special treatment of credit unions. So a new op-ed article says tax-free credit unions are thriving at the public's expense, urging their nonprofit status to expand beyond their original mandate of serving low and moderate income communities. So yes, absolutely. So more stuff there. And yet we already got those economic indicators. So that is your banking news of the week. Although, even though I have more banking news coming up here momentarily, but okay, let's get back to some articles here. How does this look? Can you guys see this? Let's just bump that up a little bit there. Okay, so I just wanted to look at this for a second. So community bank earnings stand up to tariffs for now. So U.S. community banks' strong expansion and net interest margins has bolstered earnings in the first half of 2025, but the delayed impact of tariffs will surface in the coming quarters and slow loan growth and push credit losses higher. Yes, I don't think so. Modest declines in funding costs and the repricing of fixed rate assets from the pandemic era has fueled margin expansion at community banks and double-digit earnings growth throughout the first 6 months of the year. Margins are still expected to expand further, but earnings growth should not be as strong in the second half of 2025 as the lagging impact of tariffs slow growth, weigh on the consumer, and push delinquencies higher and require banks to build reserves. Those modest earnings headwinds should provide further support for stronger bank M&A activity as institutions seek ways to grow. Now, I don't understand this. I don't understand this whole doom and gloom of like, oh, the tariffs are just going to wreck all the banks' earnings and they're going to weigh on the consumer and push delinquencies higher and require banks to build reserves. Like, really? Like, no, I don't see any of that. The margin, I think, will do fine throughout the second half of the year, especially if the Fed begins to reduce rates. Because if the Fed begins to reduce rates, that means banks will begin reducing the amount of interest that they pay out to consumers. So the bank's interest rate expense will decrease while their loan portfolio continues to increase, thus the continued margin expansion. Now, like, will that carry over a lot into 2026? Probably not. I think come 2026, you're just going to have to hope that the economy is growing well and that, loan demand really picks back up at that point. But let's look at some of the key ratios here. And this is really what I wanted to look at. So I hope let me see if I can make this a little bit bigger here. I think that probably helps there a little bit there. So, okay, efficiency ratio. 63.69% there in 24. So 25 through the second quarter, basically it's 61.98%. You've got a net interest margin so far in 2025 of 3.62%. The ROAA, return on assets, at 1.19. The return on equity is 11.35%. Year over year earnings change is 12.6%. Now they're projecting for 2025, not a whole lot of change here. Basically, efficiency ratio at 61.65, a little bit lower. Net interest margin at 3.64, a tad higher. Our return on assets a tad lower at 1.13. Our return on equity at 10.78%. And then a year over year earnings change drop back down a little bit to 8.9%. And then, 26, They're expecting the numbers to get better. 27, basically about the same. 28, about the same. So not a whole lot of variation there. But I just want to point out that a lot of these numbers are really solid. An efficiency ratio overall for community banks right now, it's 61.98. That's pretty good. I mean, that's pretty healthy. I mean, ideally, maybe you'd like to be a little lower, at maybe 60 or 59, but ideally, 61.98 is not doing too bad. If you can basically hold the efficiency ratio between that like 55 and 65% ratio, you're kind of hanging where you want to be. And if you can really keep it between basically that basically 58 and 62 area, that you're doing just fine. You're doing good. Net interest margin, 3% is kind of the industry standard. So if you could keep that number over 3% and keep it at 3.62, you're doing really good. You're doing just fine. Now, if you could get that number to 4%, if you can get that to 4% plus, you're cooking, baby. You're doing really good. Again, return on assets, 1% is kind of the industry standard. So if you're doing 1%, again, you're doing okay. You're doing just fine. 1.19%, again, doing very good. Not doing bad at all. Return on equity, 10% is kind of the industry standard. So at 11.35%, doing great. Nothing wrong with that there. Again, year over year earnings change at 12.6%. Like, that's good. So again, I just wanted to point this out just to show that the industry numbers are, hanging in there quite nicely. Now, nothing really bad here. And again, I would expect some of these trends to continue. I really think that, a lot of this talk here on the tariffs, like, this impact of tariffs are going to slow the growth and weigh on the consumer and push delinquencies higher to require banks to build more reserve. Yeah, no, I don't really foresee any of that really happening. It's just kind of wild that they kind of building some of that stuff in there. But anyway, all right. Well, let's get into some tariff news here, because I got so much stuff that I'm probably not even going to get a chance to get to tonight here. But let's run through some of this tariff stuff real quick and see how much we can get through here in the next 15 minutes here. So Canada drops many of its retaliatory tariffs on the U.S. I don't mean to laugh, but I will laugh on this one. Canada announced Friday it was dropping most of its counter tariffs of 25% on U.S. goods. The tariffs on U.S. auto, steel, and aluminum will remain in place for now. The move comes as the U.S.-Mexico-Canada agreement is scheduled for review in the next few months. Basically, Canada is finally waking up to the reality that their fight. I said this from the beginning. It's just the dumbest thing. They don't have any cards. They have no cards to play. The U.S. has all the cards, and they're hitting us with, quite frankly, they've been hitting us with some absolutely horrendous tariffs. And is that what a friend does? Like, we're first of all, we're subsidizing them to the tune of $250 billion every year. And then they've got the gall to hit us with, 300, 400% tariffs on a bunch of things. Like, I mean, how ridiculous is that? I mean, it really is unfathomable. And so, and again, all we asked them to do was come to the table and be reasonable. And these morons up there, are basically like, oh no, they're going to pound their chest and whatever. Guess what? You're losing. You're going to lose. I've said this before. You're going to lose this fight. You're going to lose. All right. It's not a question of if you're going to lose. It's when you are going to throw in the towel. And I believe that this is the first step of them throwing in the towel right here. So, good news there. Trump's tariffs will reduce the deficit by $4 trillion over the next decade. Oh, you don't say. You don't say, says the CBO report, which they put out, you got to love. They put this out yesterday afternoon, and I love how they put this stuff out there. Like, it's like, Trump's tariffs, by the way, Trump's tariffs, the CBO, we did a report, and they're going to reduce the deficit by $4 trillion. Wait, what was that? What was that? They're going to reduce the tariffs. I'm sorry. Did you say that they were going to reduce the deficits by $4 trillion over the next decade? Oh, that's fascinating. Because when you guys put out your BS CBO report a couple of months ago, you guys basically didn't include any tariff revenue. It was zero. And, and you guys blasted it and said, oh, it's going to add all this money to the national debt and all this other stuff, whatever. But now that the income is actually being included, now we actually find out it's going to reduce the deficits by $4 trillion over the next decade. Isn't that fascinating? So a report released on Friday by the Congressional Budget Office, the CBO, predicted that President Donald Trump's tariffs will reduce the federal deficit by almost $4 trillion over the next decade. If Trump's global tariff hikes continue, increased revenue could shrink primary deficits by $3.3 trillion and cut the federal interest payments by $0.7 trillion over the next decade, the CBO said. The current top tariff rates may not hold as negotiations with trading partners and international legal challenges are ongoing. We estimate that the effective tariff rate for goods imported into the United States has increased by about 18 percentage points when measured against 2024 trade flows, the Budget Office said in its report, adding that Trump's tariffs would reduce the need for federal borrowing. Wow. Okay. So now they finally told the truth. Holy cow. Finally told the truth. Now, again, I hope that you guys are appreciating something here tonight, because you're not going to hear this anywhere else. Okay, I am reporting this to you. I hope you see the value in the stuff that I am reporting to you here, because you're not going to see this anywhere else. You're not going to see this in the news. You're not going to see this on CNBC, or if you do, it's going to be 2 seconds and they're going to jump to the next thing. Because this is the truth right here. And this is what they have been obfuscating, for months now. And they finally put it out. So hallelujah. So fantastic. Okay. So Trump tariff revenue expected to offset tax bill impact, S&P says, in the U.S. credit rating hold. So the S&P Global said it expected meaningful federal government revenue from President Donald Trump's broad tariff policies to generally offset weaker revenue expected from Trump's recent enacted major tax and spending bill. Oh, again, they're finally acknowledging the strategy here. So S&P Global cited that the outlook, as it maintained its AA+ rating on long-term U.S. sovereign debt and its A1+ rating on short-term unsolicited sovereign credit, the Congressional Budget Office has forecast a $3.4 trillion increase in the federal budget deficit as the result of Trump's big, beautiful bill. So again, going back to this for a second, remember, this is the CBO. They just announced yesterday that the tariffs are going to reduce the deficits by $4 trillion. What CNBC is referring here was the original CBO forecast that they put out a couple of months ago that included no tariff revenue. That's why they said that they said, oh, well, this is going to increase these tax cuts are going to increase the thing by $3.4 trillion. Now they're finally going, oh, wait a minute. No, he's going to get all this tariff revenue in, and that's really going to offset a lot of the tax cuts that we're getting. So now, again, you begin to see how Trump's strategy, his administration strategy, it's all beginning to work. And now all the BS that you were getting here from the financial news media, they're finally starting to admit it. But of course, like I said, they do put these things out, but unless you're looking for them, unless you're digging for them like I am, you're not going to see them. Okay, the biggest retailers are thriving in the tariff economy. Wait a minute, but I thought I heard the retailers were all dying. Amazon, Walmart, and TJ Maxx are beating rivals by offering deals to stressed out consumers. Really? So in the tariff economy, retailers who cater to continuous consumers are winning. Those who don't are falling behind. Wow, that's funny. I almost recall showing you an article by somebody. Wait a minute, it was McDonald's. Oh, that's right. Yes. So in other words, if you don't try to jam all these costs down on the consumer, you're going to be okay. So Walmart, Amazon, and the owner of TJ Maxx are scooping up market share from rivals by offering shoppers good deals and convenience. Wow, shocking. In a bid to ease the burden on stressed out consumers and undercut competitors, Walmart has kept price increases to a minimum by absorbing much of the tariff cost. We're keeping our prices as low as we can for as long as we can, Walmart Chief Executive Doug McMillon said Thursday. TJ Maxx is seizing the moment by snapping up excess inventory that other retailers ordered ahead of tariffs and now need to unload. Its CEO called the buying opportunities outstanding. So Amazon made improvements to its delivery network that helped get packages to customers faster and more cheaply. That helped propel a whopping 11% increase in online store sales in the latest quarter, Amazon executives said. So far, tariffs haven't made a big impact on its prices, the e-commerce giant said. Walmart is beating out rivals like Target in part because of its low prices and in part because of a large share of its sales are groceries, an essential purchase even for cash-strapped shoppers. Tariff-related price increases are prompting more middle and low-income shoppers to focus on needs over wants. So again, you're seeing here that, it's not, and I just point this out to show everybody again, it's not Armageddon. There is no Armageddon out there, nor is Armageddon going to arrive. Like I said, again, you're going to see some things fluctuate. To be sure, is it going to be this across the board, like, oh my gosh, the economy is going to end there? No, that is not going to happen. And you're seeing this here. Walmart, Amazon, TJ Maxx, all these guys, they're surviving just fine. They're doing just fine. They're absorbing the cost. Now, again, eventually, will certain companies try to pass this cost on to consumers? Yes, they will. Some things will go up in price. But will consumers just move to a cheaper alternative? Yes, they will. Are they going to complain and grumble about those increased prices? Yes, they will. Those companies that try to force those increased prices on them, are they going to lose sales and market share? You better believe it. You better believe it. And, and that's why, again, Walmart, Amazon, and TJ Maxx, they're taking advantage of their rivals right now, who are basically trying to, play games and not do what they know needs to be done. So again, just interesting to point this out. The U.S. and the EU unveil trade deal details, capping tariffs and unlocking billions in energy and tech purchases. So the deal caps U.S. tariffs at 15% on key EU exports, including cars, semiconductors, and pharmaceuticals. So the United States and European Union on August 21st published long-awaited details of a sweeping trade framework that caps most U.S. tariffs on European exports at 15% and commits the bloc to a massive new purchases of American energy, technology, and defense equipment. The framework laid out in an August 21st joint statement builds on a political agreement announced by U.S. President Donald Trump and European Commission President Ursula von der Leyen on July 27th in Scotland. Both sides cast the agreement on a reset of the world's largest economic relationship worth more than $1.6 trillion annually. Known officially as the Framework on an Agreement of Reciprocal, Fair, and Balanced Trade, the newly announced arrangement eliminates EU tariffs on all U.S. industrial goods, grants preferential access to U.S. farm and seafood products, and sets a 15% ceiling on U.S. duties for key European exports, including cars, pharmaceuticals, semiconductors, and lumber. The cut in auto tariffs, down from the current 27.5% rate, is one of the most significant provisions for the European industry. In return, the EU has committed to purchase $750 billion worth of American energy products, including liquefied natural gas, crude oil, and nuclear fuel through 2028, and to buy at least $40 billion in U.S.-made artificial intelligence chips for European data centers. The EU also pledged an additional $600 billion of investment into the U.S. economy and said it would substantially increase procurement of U.S. military and defense equipment, a move both sides said would deepen transatlantic defense industrial ties and strengthen NATO interoperability. Again, fantastic. This is fantastic news. It's a fantastic deal for the U.S. Maybe not so much for the EU, but you know what? The EU, I don't really shed any tears, as the EU's been getting over on us for years and years and years. This is an interesting side effect. So here we go. Money wired to Mexico hits a decade low as U.S. immigration policies take hold. So a new 1% remittance tax also goes into effect in January of 2026. So the Trump administration's crackdown on illegal immigration is playing a role in the sharpest decline in monthly remittances to Mexico in more than a decade. Analysts say, according to numbers released this month from the Bank of Mexico, income from remittances abroad stood at $5.2 billion in June June, a 16.2% decrease compared with June of 2024. That represents the largest drop in 13 years, according to a report from BBVA Research. So again, very interesting there. Inside Texas Instruments, $60 billion U.S. mega project where Apple will make iPhone chips. So when Texas Instruments announced the $60 billion manufacturing mega project in July, it was a bold bet that companies would want to mass produce foundational microchips on U.S. soil. In August, Apple vowed to do just that. Wow, how about that? During the same Oval Office press conference where President Donald Trump announced a 100% tariff on chips from companies not manufactured in the U.S., Apple CEO Tim Cook upped his company's U.S. spending commitment to $600 billion over the next 4 years, up from an original $500 billion announcement in February. Part of that spending, Cook said, will go toward making critical foundation semiconductors for iPhones and other devices at Texas Instruments' new chip fabrication plants in Utah and Texas. Phenomenal. U.S. company puts up fight against China's tariff evasion. So basically, this company, what this article talks about is how China was basically trying to evade the tariffs by going through other countries. Now, obviously, we know some of that has been closed down with some of the, some of the new tariff trade agreements that have been cut with like Cambodia, Thailand, Vietnam, Japan, Singapore. So again, some of this is going to get some. Again, it's going to start to become harder for China to get around the, by going through other countries. A lot of this stuff is going to get, cut off. But here's a couple interesting things real quick. So China's rare earth shipments to U.S. jump after a trade truce. So the United States received about 619 tons of magnets last month, a surge from 46 tons in May. So that was good. But China also tightened rare earth management with new regulations. So the measurements require companies to report the flow of production monthly and expand the quota system to control the sector's mining, smelting, and separation. So again, China might be increasing what they're giving us, but they're also putting a lot of constraints on it as well. All right, and you know what? We'll have to save some of this for the next time. I did have a bunch of other stuff here that I wanted to get to, but we'll come back to that. Next week is another week, as they say. I want to get to our story of the week and quote of the week. But before I get to that, I just want to run down a couple of items here. So things that you can do to basically help the podcast real quick. So if you are listening to this, if you're an Apple podcast or a Spotify listener, I'm looking for reviews. So if you could please, if you like what you're hearing, you like the podcast, you like the episodes, you like the live stream, please leave me some reviews on Apple Podcasts and Spotify. That would really help. If you've never visited thebankernextdoor.com, please go check out the website. That would really help. Bankernextdoor.com. Go check the website out. Make sure to subscribe on YouTube if you want to get. I put up a lot of posts on YouTube where I talk about, especially on Sundays, I put up kind of a list of here's all the episodes coming out this week. If there's certain things that I'm going to be covering during the live stream, I like to put that out. Any kind of big announcements, whatever, so if you want the kind of latest up-to-date news, like I said, subscribe on YouTube. You'll see all the latest posts and stuff that I put out. You can send comments, questions, or topic recommendations to info@thebankernextdoor.com. So send that to info@thebankernextdoor.com. That will definitely help me out, especially if you got a topic that you like to recommend. Again, info@thebankernextdoor.com. So you can also follow me on Getter, Truth Social, and X. I put up a lot of commentary on there. Remember that Banker Next Door is on YouTube, Rumble, and all the major podcast platforms. New episodes every week, Monday through Friday, premiering at noon. And then the BND Strategy Room is every Saturday night at 8 p.m. So let's go to our story of the week. So as I said at the very beginning, our story of the week this week is on the Jackson Hole Economic Symposium. So the Jackson Hole Economic Symposium is an annual symposium sponsored by the Federal Reserve Bank of Kansas City. First held in 1978, it moved to Jackson Hole, Wyoming in 1981. Every year, the symposium focuses on an important economic issue that faces the world economies. Participants include prominent central bankers and finance ministers, as well as academic luminaries and leading financial market players from around the world. The symposium proceedings are closely followed by market participants as unexpected remarks emanating from the heavyweights at the symposium have the potential to affect global stock and currency markets. So there is the Jackson Hole Symposium. So, and then finally here, what is our quote of the week? So, there are no great men. There are only great challenges, which ordinary men like you and me are forced by circumstances to meet. And that was Admiral William Halsey. And Admiral William Halsey has some great quotes over the years. I'm sure in the weeks and months ahead, I'll be sharing you some other quotes by Admiral Halsey because he had some really good ones. But I really like that one there. There are no great men. There are only great challenges, which ordinary men like you and me are forced by circumstances to meet. Kind of reminds me of the Lord of the Rings. If you ever read the Lord of the Rings or seen the movies, you understand how that might tie in. All right, guys. Well, that's the show for the week. I thank you so much for hanging out with me on this Saturday night. As always, just be safe out there. Have a great weekend. We will be back here again next Saturday night at 8 p.m. for more of the Banker Next Door. You'll be back in the strategy room. Until then, have an awesome weekend. Thank you for watching. Thank you for listening. And I'll see everybody again next week. Later on.